Madison Kiza, and today we're going to be looking at company-owned policies and tax consequences. Now, in order to make it simple, I thought I'd divide the first section for income tax and company-owned policies, and then the second section for estate duty and company-owned policies. So let's have a look at that.
Angie works for an international civil engineering company. Since expanding into Africa, Angie has proved to be an invaluable resource in the company's success as a business development consultant. What makes her thrive in a tough and competitive environment is not only her experience and education, but the fact that she is multilingual. Being multilingual certainly helps the company navigate through complex issues in different jurisdictions. With the company having been recently awarded a contract for the construction of a bridge in Zambia, her services are vital. The project is estimated to take at least 3 years. The company realizes that without Angie, the project would be greatly derailed, especially at its infancy. Losing Angie could be catastrophic for the company. The question is, how could the company protect itself against financial loss if something happens to Angie? And what can the company offer Angie to mitigate against an unplanned event such as death? The company does not want to come back home due to unplanned events happening to their important employee.
So before we carry on, I think it's important to split these company-owned policies further. So we're going to discuss policies that are for the benefit of the employee. And then secondly, we're going to discuss policies that are for the benefit of the actual company itself. And you'll see that there are slightly, or not slightly, but there are differences in the way we treat the policies depending on who the policy is going to benefit. So the first part is we're going to start with fringe benefit policies. That's what we basically typically call them, for at least for the sake of our reference. And those are the type of policies that benefit the actual employee. And then secondly, we're going to look at the company-owned policies, which we generally call key person policies, for sake of reference. Those are the policies that generally, those are the policies that benefit the actual company for a loss of an employee who has been insured. So let's first have a look at the fringe benefit policies. The other important thing to just take a note of before we carry on is we're talking about income tax on the first part, and that is not with regard to benefits that are approved benefits. In other words, group benefits, for example, offered by a pension fund. Those get entirely handled differently from a tax perspective, and that's a topic for another day. So we're talking about unapproved benefits at this point. So because AB Construction is also worried about Angie as an employee, they decided to take out a policy, we're going to call it policy 1, on the life of Angie, so that if she passes away or is disabled or something like that, at least she's got the spouse to be looked after, the child, dependent, or any nominee that she can choose. So what ABC Construction Company decides to do is, as an owner, they take out a policy on the life of Angie, so that on Angie's passing away, and if something happens to Angie, that it is Angie, and like I said over here, the beneficiary could be a spouse, child, dependent, or nominee. Say, for example, in the event of death, and then obviously in the event of disability, the beneficiary could be Angie herself. So the whole purpose that AB Construction is taking out this policy is to benefit Angie, whether in her capacity or in some way her relatives that they can benefit. So hence it's called a fringe benefit policy, because it ultimately benefits the actual employee, in our case being Angie. So if we assume, for example, that this policy has been taken out by AB Construction, let's just assume that the premium is worth, say, 2,000 rands a month. So what's going to happen is that AB Construction is going to pay over to the insurer, whoever the insurer is, that 2,000 rands per month as a premium. Then in the company's books, so let's assume, for example, that the premium is being paid on a monthly basis. So in AB Construction's financial year end, the total premium paid for that year will be 24,000. Now, before we get to that, so let's assume that the company AB Construction has made a profit of, let's say, R1,000,000 for that year. So now there's obviously, we're really trying to keep it simplistic here and focusing on this policy. I'm not going to talk about all the other deductions of the company, obviously. So if we know that the company has been paying this premium of 2,000 rands per month for 12 months, that means for the total year, the premium paid by the company is 24,000 rands. Now, because this is basically an expense in the company's hands, they can actually deduct it. So that leaves them with a, if you take the R1,000,000 profit and you minus the deduction of the premiums that they've paid, that leaves you with a net profit of 976,000 rands for that year. 976, sorry, that is a 6. So that means before 27% tax applies to the company at this level here, we're first going to reduce it by the amount of the premiums of 24,000 rands before we tax it at 27%. And obviously that reduces the company's taxable income. Now, in Angie's books, let's just keep it simple. Let's just say her total cost to company is 100,000 rands per month. Now, that salary could be structured in various ways. Now, to keep it simple, for example, let's just say that the AB Construction has said that out of this 100K, 76,000 of it will be in cash. In other words, it's basically a salary. Okay. And that the remaining 24,000 rands is actually this fringe benefit we're talking about here. So I'm just going to put it here in inverted commas, fringe benefits. Now the 76,000 plus the 24,000 will equal the cost to company of 100,000 rands. Now, in Angie's perspective, this whole amount here, whether it be made of salary and fringe benefits, I'm just going to make it simple, it's going to be taxed at Angie's marginal rate of 41%. Now that's in terms of section, or rather paragraph 2K of the 7th schedule. Now, what that basically means is, I mean, if we had to assume that this whole 100,000 rands, without splitting it between salary and fringe benefits, would have been taxed at 41%. The point is, whether you split this, whatever you split, in this case, 24,000 rands, the fringe benefit, it's going to be seen as a salary in a sense. Of course, in this case, called a fringe benefit. The net effect is that it's still going to be taxed at 41%. So in Angie's books, it doesn't make much of a difference from a pure tax perspective. Now, this fringe benefits, because now we know that the cost to company is 100K for Angie. During every month, as this 2,000 rand premium is being paid, and as Angie earns a 76,000 rand premium, obviously there's payee payable to SARS, and that payee is going to be calculated on the total of Angie's salary and fringe benefits. So every month, some payee is going to be payable over to SARS. In other words, the tax on the fringe benefit on a monthly basis is being deducted and payable over to SARS. Now, just coming back to this policy of annual premium of 24,000 rands that AB Construction is paying over to the insurer. Before they can deduct this premium, there's a couple of requirements in certain section 11 WI that have to be met. And that the first one is that the employer, in our case, AB Construction, is in fact the owner of the policy, and that the policy covers death, disability, severe illness of the employee or director. And that the third one is that the deemed, is that the, and the third requirement is that the 2,000 rands payable over to the insurer as a premium must have been deemed a taxable benefit down here in the employee's hands. So those are the three main conditions that have to be met before the company can actually be able to deduct this premium. So what we've looked at so far is at what happens, what's the income tax position at the start of the policy or during its the life of the policy. Now what we're going to move into is what happens at death or disability or some sort of event that triggers a payment, which basically means at the end when the benefits pay out, what is an income tax position at that point? So let's take a case of disability, for example. Let's say Angie, while working, she suffers a disability. Now, let's assume that the policy that she was insured for disability was for 1 million rands. Now, the insurer will pay that 1 million rands to Angie. However, there's a very important definition of what gross income is. Gross income is in the Income Tax Act. And paragraph D specifically includes these payments to Angie. So this 1 million rands would first be seen as part of Angie's gross income. So if Angie is making 100,000 rands per month times 12, that's 1.2 million rands. So if Angie gets disabled at the end of that 12-month period, her gross income will be seen as 2.2 million rands. There will be ways to deduct going down the line, but I think that the most important thing is, remember, from a tax perspective, SARS you have to disclose all these figures to SARS. So then after that only we'll know what to exclude, what to deduct, whatever the case may be. So it's all about disclosing everything and then managing everything going forward. So in terms of paragraph D of the Gross Income Tax Act, this 1 million rands will be seen as part of Angie's gross income. However, there is an exemption. And the exemption really goes to, it's contained in section 10 G, capital G of the Income Tax Act. And that says, you remember that AB Construction, they were paying 2,000 rands premium per month for this policy. And they were reflecting it as a fringe benefit in Angie's, for Angie in terms of income tax. Now, because they were reflecting it as a fringe benefit, it means that the employee, Angie, has been, via the payee system, been paying tax on that fringe benefits. So the important requirement for us is that if we do not want this 1 million rands to continue to sit in Angie's gross income, we must make sure that the company was in fact levying fringe benefit tax and paying it over to SARS during that year through the payee. So then the final result is basically, we know that, let's say, for example, Angie gets disabled at the end of the year. So we know that her total annual salary is 1.2 million for the year. And now we've got this 1 million rands disability paying out. And in terms of the definition of gross income, we know that we have to include this, so they're giving a total of 2.2 million rands. However, what we're saying now, because of section 10, G, capital G, Angie has been paying fringe benefit tax on this fringe benefit that the employees has offered. And because that has been happening, we can now subtract, or in other words, this can be seen as an exemption from her gross income, therefore bringing it back to the 1.2 million rands gross income for the year. So the important thing is, we first, in terms of paragraph D, we first included, SARS needs to see that it's come in, and then later on, depending on whether fringe benefit tax has been levied or not, then we can qualify for an exclusion. Now, no, in this example, I use the case of disability where this 1 million rands pays to Angie. The case could be, for example, death cover where Angie is no more, it's passed on. But on the policy, she may have chosen a spouse as a beneficiary, child, dependent, or some other nominee. Exactly the same principle applies. That 1 million rands would have been seen as Angie's gross income on a date of death. And then because she would have paid, in our example, fringe benefit tax, we can later deduct it. And therefore, the net result is that the 1 million rands is actually income tax free. So we know that now Angie's been looked after by the company AB Construction from her personal perspective. If something happens to her, and they've provided her with a fringe benefit policy that either benefits her, spouse, child, dependent, or nominee. So that policy has been done. However, we still live with the question, what happens if something happens to Angie still, but then the company suffers a loss? We've mitigated Angie's loss. Now, how do we mitigate the company's loss? Now, in this scenario, let's say AB Construction has again taken out a policy for R1 million on the life of Angie. And let's say this is the second policy now. Let's say again the premium is 2,000 rands per month. Now, straight away, you realize that now the beneficiary is AB Construction, because it's not a fringe benefit policy anymore. It's a company-owned policy that is designed to benefit the actual company against the loss of Angie. And again, you'll see under Angie, as in the previous example, there is no talk of a spouse or beneficiary or dependent or anything like that, because this policy is designed to benefit the company itself, AB Construction. Now, unlike in the case of the fringe benefits policies, where if a fringe benefit is offered to an employee, the employer can deduct that fringe benefit. If it doesn't, he loses it. It's advisable just to deduct it, so in order to reduce that taxable income. In this scenario where the company owns the policy but for its own benefits, in the case of a key person policy, the company has two options. They can either choose to have those premiums 2,000 rands per month times 12, 24,000 rands per annum. They could choose to have that premium deductible in order to reduce their income, their taxable income, or they can choose not to deduct their premium. Now, there's consequences for choosing either reason. I'm going to focus more on the second one, because the first one is quite straightforward. So if the company in our scenario pays for that policy on that it owns, the 2,000 rands per month, and it decides not to deduct the premiums, that means at the end, the benefits that pays out to the company will simply be tax-free. Now, the scenario that we're going to focus on is the example I'm going to look at now is what happens if the company decides to deduct those premiums at 24,000 rands per annum. What is the effect at the end when the benefit? So again, let's assume that the company's profits were R1 million for that year. And we know that in order for them to deduct the premiums, we'll talk about the requirements they have to meet just now, but the premium is 24,000 rands per annum. So they want to get to a position where their taxable income has been reduced to 976,000 rands. Now, in order to qualify for this deduction, certain conditions have to be met. And that's all contained in Section 11W2 of the Income Tax Act. Now, the first one is that the employer must be insured against the death or disability or illness of the employee or director. So that loss that they're insured against must be as a result of this employee. He has something happening to this employee, which is why Angie is the life assured. The second one is that the policy must be a pure risk policy. In other words, there must be no investment component on the policy. And then the third requirement is that the employer must have been the actual person who paid this premium over to the insurer. Obviously, you can't get a deduction if somebody else paid the premium. So those are the three requirements that have to be met. And you might have noticed, in order to meet these requirements, when you're doing a quote, and I've seen with some insurers, you'll have to specifically tick whether you want these requirements of Section 11W that I've just said to apply in order to be able to deduct these premiums. So that quote sometimes is just to tick a box on the quote system where you say, yes, I want to make sure that the premiums are capable of being deducted, so that you can deduct them under here and reduce your taxable income. Otherwise, if you don't select that, it's the first option where the premiums are not tax deductible. However, the payout at the end is completely tax-free. So it's a very important distinction to make between the two policies in order to make sure that they get the status of being tax deductible. So now what happens at the end of the life of the policy if something happens to Angie? So let's say there's a death, Angie passes away. Now, the company had taken out a policy, the insurer will pay out to the company the 1 million rands, which was covered for. Now, in terms of it's paragraph M of the definition of gross income, we must include this 1 million rands in whatever other income that the company has made. So let's just quickly do an example. So we know that the company has made 1 million rands for the tax year. And in terms of paragraph M of the definition of gross income, we must include whatever proceeds come from this policy that covered death, disability, or severe illness. So that means that the total income for the company is 2 million rands. Now, very important distinction to make at this point. If, as I said earlier on, if the company had decided not to deduct that 24,000 rands premium per month, that means, sorry, this is a 4. If they decided not to deduct this 24,000 rands premium against the taxable income, that means this 1 million rands payout from the insurer would not come in here, and the payout will be completely tax-free. In other words, the gross income of the company will just be looked at whatever profits they made during their operations. However, in our example, when we looked at the second option where we wanted to deduct the premiums, then we have to, I'm going to write it up here, we have to say, we know that the company made 1 million rands profit for that year, or income for that year. And because we've chosen to deduct this 24,000 rand premium, the exemption, therefore, for this 1 million rands life cover that pays out will not apply. So this income will, sorry, it's not an income, but the payouts from the insurer will stay in the definition as per paragraph M as 1 million rands, and therefore giving you a total gross income of the company of 2 million rands. Now that means, you know, if a company tax rate is 27%, you're obviously attracting a bigger tax because you're taking into consideration what the company did in the year plus the proceeds of the policy. But that is because you had chosen to deduct these premiums. So the consequence, therefore, is the minute you choose to deduct these premiums and reduce your taxable income, at the end, the payout, this payout shared by the insurer of 1 million rands will stay in terms of the definition as part of your gross income, and therefore attracts tax at 27%. So that's the consequence of deducting the premiums. You know, so at the end of the day, there is no right or wrong answer of doing things. It's just really just depends on a case-by-case basis, client to client, and it is a bit of maths involved just to see which position is better. I mean, for example, clients, I met clients that decided to opt for deducting their premiums because the premiums were quite high and they needed the cover. However, they went with that option and got less worried about the payout being taxed because they knew that they were running a project that's going to last for 5 years, and they were stressed. They needed the cover. One of the key individuals was not in great health. So the minute they secured that cover, they couldn't afford it, but they decided to make it deductible, at least to reduce their taxable income. So there's no right and wrong answer. It really just depends on a case by case basis. But as long as you do a bit of number crunching, just to get a bit of an idea, you should be able to guide your plans. Otherwise, I hope that works. And yeah, we'll chat next time. Thanks.